If you want to know how you can build wealth steadily without stressing over market volatility, then let's break down the concept of dollar cost averaging, which is simply abbreviated as DCA. This is a game-changing strategy that can make growing your wealth over time much easier. So what exactly is dollar cost averaging? It's pretty simple. Instead of investing a lump sum all at once, you invest a fixed amount of money at regular intervals, regardless of the market's ups and downs. Think of it as setting your investments on autopilot. Let's say you decide to invest $200 every week or month. When the market is high, your $200 buys fewer shares. When the market is low, your $200 buys more shares. Over time, this averages out your purchase price and reduces the impact of volatility. Cool, right? DCA is a fantastic way to cultivate discipline and consistency in your investing habits. You don't need to time the market, which is something even expert investors can struggle with. Plus, it takes the emotional roller coaster out of investing. So here's the real flex about DCA. Historical data shows the market tends to go up over the long term. By sticking to DCA, you're essentially buying into that growth little by little, while bypassing the market's intermittent ups and downs. Less stress, more gains. But don't forget, DCA is a long-term strategy that requires patience and commitment. The key is to start with what you can afford and stay consistent. We recommend a good S&P 500 ETF. Most of them average over 15% returns year over year. So there you have it, one of the best investment strategies around, dollar cost averaging. A simple, smart way to build wealth over time, without the stress. If you found this video helpful, hit that like button and subscribe for more smart investing insights. Thanks for watching, and check out the links below for how you can get started with a DCA plan right now.